is the Insider's Guide to Real Estate, and I'm your host, Victor Normand. Today, my guest is Don Ludwig, who is a principal with Farm Family Insurance in Westford. Welcome.
How you doing, Vic?
We're doing fine. So, property insurance. Insurance is something we're all familiar with. Anyone who owns a home, it's a good idea to have it insured, and if you've got a mortgage on it, you really don't have any choice. Right. So let's take it from the perspective of somebody who is buying the first home and really hasn't had much experience with insurance. They need property insurance. They've been told they need that. Where do they start?
You know, what they want to do is really approach an agent. It's really the best model. Of course, I'm a little biased, but really the best model to understand, what the right coverage amounts are, what the right type of coverage is. There's a lot of noise around the internet and 800 numbers, but it really, takes longer than 15 minutes to kind of figure out what the right value is and what the right endorsements you need and what the right coverages you need. So, I really recommend people sit down with an experienced licensed agent and figure that out. Okay,
so when they make an appointment, they meet an agent, what kind of information do they need to bring with them?
Yeah, for the most part, a real estate listing gives an idea. We could do it with simply just the address of the property. There's various ways we can get assessor's data, go online through tools like Zillow and get the characteristics of the home. But, generally what you want to do is capture all the characteristics of the home so that you can plug those in and have it go against, a program that most insurance agents use and insurance companies use that will check, regional labor rates and material rates and actually based on the characteristics of the home, it will create, what we call a replacement value for that home. So what would it cost to actually rebuild this home? You have a fire, we have to remove all of the stuff, that's all charred and burned and actually start new and rebuild exactly what was there, whether it's a partial or full loss in a house.
So I'm starting off and I know what I'm paying for the home and I just want it insured. What are, some of the things that I might not be thinking of, but could become problematic in the event of a loss?
Yeah. I mean, first off, that value that process creates is the replacement value, and oftentimes that has really no bearing to what the assessed value or what the market value. So it may be much higher or much lower than what you paid, depending on the property. Older homes are going to have a much higher replacement value because there's vintage period construction, and when they say replacement, they're actually replacing that style of construction. So if you had plaster and lath walls and you had custom old school moldings, they're actually going to mill and replace those exactly the way they were. So the things you want to think about are, what's my attachment to keeping this house in its period style, for one? Do I care that I have plaster and lath walls, or would I be, just as happy to have that go away and just have normal, blue board and skim coat walls like a modern house would have? Do I care about all the period moldings, or do I, want just kind of off the shelf lumber store or, Home Depot type moldings? Can I live with that? Because, that can impact, what the premium's going to be and, how we actually value and insure that property. So, those are the kinds of things you want to think about.
Okay. So I might not be thinking about that. I'm just thinking the house is insured, and those kinds of things may become important to me when there is a loss. Now that I've gotten used to, these finishes, and I really expect them to be replaced. And the expectations in insurance is going to be there to do that. But I am concerned about cost. I've got the insurance is a factor, and for many mortgages, the insurance premium is actually escrowed every month.
Right.
And we all know that what really matters is to consumers is what's it going to cost me every month. So what are the kinds of things that a home buyer might be able to do to lower their insurance costs, but yet be protected?
Yeah, and there's always a balance. No one wants to be insurance poor, and I pay insurance premium, so I understand that like everyone else. But what you need to do is find, like I said, what's the right model for covering that home? Is it full replacement? Are we going to replace exactly what's there? Is it what's called a functional replacement, where we're not going to replace exactly what's there? We're going to use like-in-kind materials, modern materials, instead of vintage materials. So coming up with that right value, that's going to have an impact on the premium. Looking at deductibles, the higher the deductible, the more break you get on the premium. So looking at deductible levels, looking at other ways that the homeowner can self-insure on certain things in order to generate sort of a lower premium for them on a monthly basis.
Okay. So at what point what's the standard deductible that people typically get, and then at what point or how much of a deductible increase can a buyer pay and see a significant reduction in the cost of the insurance?
Yeah, I think deductibles have kind of come a long way. I think initially everything was a $500 deductible. Everybody wanted a low deductible, and then as people wanted to look for ways to cut down the cost and self-insure, insurance companies got creative and came up with higher levels of deductibles. So I think the typical deductible people do today is $1,000. Some people are doing $2,500 deductibles. We have $5,000, $10,000, and then there's percentage deductibles where you could do a 1% of the value of your house deductible. So it really comes down to what's your risk threshold, and what do you feel like you can self-insure, you can cover at the time of a loss. Because what happens with that is, if you have a $60,000 claim, that first $1,000 is yours, and then everything above that the insurance carrier pays. And, for that, there's X premium. If you have a 1% premium, deductible, then you're going to be paying a much higher percentage of that initial claim. Therefore, the insurance company is going to reward you with a much lower premium rate. So,
how much lower?
As you get up into the $1,000, like I said, has kind of become the norm now. So as you get up into $5,000 and $10,000 and into the percentage level deductibles, you see significant rate drops. Again, it's all dependent on carriers. Every carrier's got different formulas for doing that.
Okay. All right. So I've bought my house. I've insured my house. Time goes by. It's 10 years down the road. The value, the replacement value for my home 10 years later may be likely to be much different.
Yeah.
How do we correct for that?
Yeah, and I think that's something that oftentimes is not focused on, and I think it depends on the insurance carrier and depends on the agent, right? So I think I can speak for myself. What I try and do is do what I consider a professional insurance review with my clients at least every year, if not every 2 years, where we sit down and go through all their insurance. People's lives are changing all the time, so and people don't always think when something significant happens in their life to call their insurance agent. You might think about it if you're getting a new car. You're probably going to think about it if you sold your house, but if you made a double the size of your house in the addition, you might not think to call your insurance agent and change the value. So some carriers will every year at renewal take those characteristics that they captured and run new values to make sure that they're insuring to value, making sure that replacement cost is still valid. But again, if you didn't call me and tell me that you added on a 4-car garage with a full master suite up above, then we won't have those characteristics captured, so we won't know, and that value won't be accounted for in the value of that house. So you may very well be underinsured.
All right. So I know some insurance policies will come along and they will. I've seen where they offer you an opportunity to increase the value of your home. So that's something that if whether you take advantage of it or not, it's time to take a look at what that value is.
Yeah, really, as the homeowner, you really should keep an eye on that value. I know a lot of people get the renewal insurance policy and either immediately file it, take the bill out and put it in the pile to be paid, but you really should look at it and really kind of think through, hey, is this amount reasonable? I mean, the agents should be doing that and trying to keep up with that, but you definitely want to make sure you have the right values on there. And there are endorsements you can put on that put an extra amount of insurance above and beyond what you have coverage for that a lot of carriers are offering today, and that's to really cover that scenario where you have a claim and they come to find out you were woefully underinsured, and so now there's an extra amount of insurance you've been paying for in an endorsement, and the insurance carrier will insure up to that value. But again, these are contracts, and when they say they're going to replace your home exactly what you have up to the value you have coverage for, that's what it means. So if it's going to take a lot more to replace that home, you want to make sure you don't have a large gap there. You're going to have that coverage.
Now, is it possible to overinsure a home?
Yeah, it's possible to overinsure, absolutely. And so you want to have, you want to be sensible about it and make sure you've got some sort of science and methodology behind coming up with that value. Okay. You can't just ballpark it. And like I said, old Victorian, or 1700s home, the replacement value on that is going to be significantly higher than, a new house that was just built 2 years ago, because like I said, the vintage level of construction, it's not as straightforward as just, pouring a new portion of a foundation. You've got fieldstone foundations, you've got balloon framing, you've got custom hand-hewn beams, you've got plaster and lath, all of those things, if you're truly replacing what was there, have to be replaced and take craftsmen, and that costs money.
Sure. So the key is it's replacement value. So regardless of the dollar amount in my policy, I can't expect to get a check for that. What the insurance company is going to be doing is actually replacing what's there.
Right. Right.
Okay. So let's say that I've got this house and I'm dutifully adjusting the value every year, and you're calling me up. But what I'm not telling you is that I now I've started collecting things, antique furniture, and so
Right.
now I've got let's talk about contents. There's a standard amount of property insurance that deals with contents, and what is that usually?
Yeah, I mean, generally, the rule of thumb is 50% of the value you put on the building for replacement cost, you put in the category called contents on your policy. So your policy will have coverages A through F, and each one is a different thing. A is the value of the building. B is a percentage of that covers other structures. If you have sheds, or you have a detached garage building, or you have a barn, or some other structure, a pool cabana, things on the property. C is contents, and that's all the stuff that's inside the house. And the way I like to describe that is, if I could take your house, tip it upside down, and shake everything that falls out, falls into that content. So you want to think about that and make sure you have enough value in there. Some people are over-insured on that because it's 10% of what you cover the house for, and you may live a simple life and not have a lot of stuff, but you may have a lot of antiques, you may have coin collections, stamp collections, gun collections, valuable art, and all of those things you want to make sure you're talking to your agent about, because contents have certain values depending on the type of item they are, and so the insurance company might only pay you up to $1,000 for a piece of jewelry, but you might have a $10,000 engagement ring. So you want to make sure you have an appraisal and you actually have that piece of jewelry scheduled on your policy. And you can schedule art, you can schedule antiques, you can schedule jewelry, you can schedule all types of things.
Okay. Well, let's talk about that scheduling items now. Clearly, if I went out and bought an antique piece of furniture and I paid $10,000 for it, what's the process? Do I just give my agent a call and say?
Yeah, give the agent a call. Give them a copy of that receipt. A lot of times with antiques, there's an appraisal, and it's either what you've market value you paid for it at that time. Or if it's going to appreciate over time, then you'll want to get an antique appraiser to come in and appraise it again. But you submit that to your agent and tell them you bought that, because you want to make sure you're getting full value for that.
Right. So somebody breaks into my house and they steal this one piece of furniture.
Right.
Does the deductible apply to that as well? Or?
No, with scheduled items, you may not have a deductible on it. Again, it's going to be dependent on how the insurance company works, but most times you won't have a deductible on a scheduled item. You'll actually get that full value, which is why you want to do that. Otherwise, you might not only have a deductible, but you might have a cap on the amount they'll pay for that category of item. Okay. So, we might only pay up to $1,000 for a piece of art. On your $10,000 or $2 million Van Gogh, you might not have full coverage on that unless you've got that scheduled.
Sure. And you can see how over time somebody, the first piece of furniture they bought, doesn't necessarily add a lot of value, but over time they could have a house full of very expensive furniture, and it could come as a very unpleasant surprise to them in the event of a loss if they haven't done something like scheduling this insurance.
Yeah, anything like collectibles, antiques, valuable Oriental rugs, all of those things. You generally have an appraisal for it. Jewelry appraisals are easy. You go to the jewelry store, pay them, generally on average about $100 and $150. It's often a percentage of the value of the item. And they'll give you an actual certified appraisal, and then now you can insure to that amount versus insuring it for whatever the insurance company thinks you should insure it for.
And the cost to schedule, I mean, it should be
cost to schedule is compared to the cost of not scheduling it and losing it is pretty small. So I think, again, you gotta, each carrier's got different rates for things, but I'm continually impressed with how little it costs to schedule it versus, the horror you have when you find out you've lost it and you haven't scheduled it.
Right. So if you've got valuable things inside your home, it's worth, at a minimum, a conversation with your agent.
Absolutely. And that's what I encourage my clients to do. Anything like that, let's talk about it.
Sure.
Even if it turns out, we don't have to do anything, at least just let me know and we'll make that decision. But it's better to have that conversation now than later.
Absolutely. So let's talk about another aspect of homeowners insurance, and that's the liability side of it.
Yeah.
When you buy a homeowner's policy, there's property damage and liability. So what kinds of things does the liability portion of the policy cover?
Yeah, a lot of people don't really understand the liability. I find when I talk to clients, and what the liability does is that's basically going to cover you personally for any claims against you for bodily injury or property damage. So it's going to cover you from everything as simple as someone slips and falls on your property and sues you to someone who claims you've defamed them or any other claims against you. So there are exclusions, there's all sorts of things around that, but in general it's where you get coverage for legal representation, if someone comes after you claiming you've caused bodily injury or property damage.
So even in a situation where you think the claim is pretty frivolous, there could be some extraordinary legal expenses that you would need to incur to defend yourself, and the insurance would pay for that, and that's a significant
and you always want to plan for the worst case scenario, that there is a legitimate claim and you lose. What do you do at that point, and how much liability protection do you have? So the conversation with the agent really needs to be, what are your exposed assets? It's sometimes an uncomfortable conversation for people, but you really have to understand what's exposed. If someone were to successfully sue you and force you to come up with X millions of dollars because the jury just decided that that was what was awarded, how are you going to come up and pay for that? And that's really where your liability coverage comes in. So you really need to understand your assets exposed. A lot of policies have a very low liability limit on there because no one's had that conversation when there may need to be higher limits. You can go up to $1 million on a homeowner's policy, let's say.
So if you need more than $1 million, how do you deal with that?
Yep. So the way the industry dealt with that, at the point in time people's assets started expanding and people needed coverage for more than $1 million. I mean, quite frankly, if you think about it around here, by the time you add up people's houses and what they may have saved in retirement and have in the bank, stocks, those types of assets, they can easily be over $1 million. So what the industry came up with is what's called an excess liability or an umbrella policy. And the reason it's called an umbrella policy is because it sits on top of all of your personal lines policies. So it'll sit on top of your homeowner policy and your auto policy, as a simple example, and it will basically provide another level of liability protection. So if, let's just say you have $1 million on your homeowner policy, but in your conversations with your accountant and with your agent, you decide that you've got exposed assets of $3 million, you've got a $2 million gap there. So with the excess liability policy, you can get a $2 million umbrella policy that'll close that gap and give you a total of $3 million in liability protection. One on the homeowners and then two on the umbrella liability.
So this liability aspect of a homeowner's policy, even without an umbrella, covers individuals and families beyond their own property.
Right. It follows you around. So, if you're accused of property damage, causing property damage or bodily injury, regardless of where you are, you're going to have representation through your homeowner's policy. Now, there are, lots of exclusions. If it's related to business or, there's other things, it's going to be excluded in that policy. But just know that that's the first place you should look to if you get served and someone's going to sue you. I mean, just like you wouldn't operate a business without liability insurance, you can't operate your personal life without liability insurance.
Right. So the last thing we want to talk about, just briefly, with respect to property insurance, is flood insurance. So just what's the one bit of advice you can give homeowners with respect to flood insurance?
Yeah, flood insurance is something that's only offered through the National Flood Insurance Program. So it's a federal program. Generally, you're not going to get flood insurance unless your bank, your mortgage company tells you you need it. So that's really where you go, or you have a coastal property and it's the only way you can effectively get coverage for your building. So the flood insurance, each town has maps of the floodplains, and the bank will tell you that you need it. You want to go to an agent who's qualified and trained in selling flood insurance. They'll look up where you are in the floodplain, look up the rates for that, figure it all out and put a flood insurance policy in place for you.
So when you say there's only one place to buy flood insurance, the inverse of that is homeowners' policies don't cover floods.
Right. Homeowners' policies exclude floods, and floods has a very strict definition. It's not a torrential rain. It's not melting ice. It's literally water leaving its boundaries, and it has to be a river, stream, ocean. There's not that there's one place to get flood insurance. There's only one insurance company that writes flood insurance, and that's a federal insurance program.
Right.
So that's where you get that, and there's multiple agents and other outlets in order to get that insurance. But
so it's something that not to be overlooked, and if you don't have a mortgage, flood insurance is not required, but you may want to think about it.
You may want to think about it, especially if you're in an area that's very prone to flooding. I mean, we've just seen down in the Carolinas where they've had 100-year flood levels, and so you just don't know. So certainly, if you're in a coastal area or your house is right on a river that tends is prone to flood, whether you have a mortgage or not, you might want to think about getting flood insurance.
Right. So we all know about insurance. The key is you should be continually aware of it and talking to your agent.
Yeah.
So I just want to thank you for joining us today on our program. That's our show for today. See you next time.